There's been a renewed interest in gold as the equity markets take a knock. As a traditional safe haven, many have been surprised that it's taken this long for gold to see any gains at all. With more of what's been behind the move and where next, Simon Popple joins us from Brookville Capital. Simon, welcome.
Hello.
What gives us the right sort of frame of mind to think that now is a good time for gold?
Well, there's an awful lot going on in the world with trade wars and this escalating debt. And I think no one really knows where things are heading, but I think in these times there's a feeling that it's less risky to hold gold than not to hold gold. And in particular with the increasing debt pile going on throughout the world, I think that people are becoming more and more nervous as to the way things are developing, and so it makes sense to review it and have another look at gold.
Yeah, let's bring up the chart and take a look at where we are in terms of spot gold. In fact, I think it's interesting to note that the bottom down here, when we saw it at $40 odd above the 1,000 level, that's pretty much the point at which the Fed started to raise interest rates. Now, it's interesting that we've got this period where interest rates are rising, the dollar's seen as an attractive opportunity in that environment. What is it in that context should we be considering?
Well, with escalating debt, I mean, we've got more and more debt, and therefore with higher and higher interest, you've got the service costs for the debt are going up and up. And therefore people are looking at where they can park their money. And at the moment, gold is one of the few assets which appears well priced. There's quite a lot of assets like real estate, equities and bonds, where people are quite nervous because they're either at all-time highs or close to all-time highs. So gold, given its sort of safe haven status, is something that people are sort of having another look at.
Yeah, let's look at a chart on this, the first chart that we've got here, which is rising interest rates paired with central bank balance sheet reduction, and I think it says here, doesn't it, that green vertical line there that I was talking about as the beginning of the US interest rate cycle. But it is alarming, actually, the size of the Fed balance sheet, as you said, generally the amount of debt that's been taken on.
No, exactly. I mean, not only is there a huge amount of debt on the balance sheet, but now there's been a switch from quantitative easing, i.e. more and more debt, to tightening. And we're in uncharted territory with this. No one really knows what's going to happen. And therefore, especially with the interest rate or Fed rate going up, the debt burden, the cost of servicing the debtors is going up significantly. And so with trade wars and all these things going on in the world, I think people are sort of thinking perhaps now is the time to have a look at gold, especially physical gold, and to have at least some in their portfolio.
I think this is the second chart that you brought along, where it shows US government debt and the annual interest payments neatly shown to us in bars here. And I mean, this well, says it all, and just really what you've been talking about.
No, absolutely. I mean, here you see the public debt growing pretty much exponentially, and the interest expenditure doing likewise. And every penny that goes on interest expenditure is money that can't be spent elsewhere. And so if the debt increases or continues to increase, especially if the Fed rate increases, that gold line is going to continue to go up.
And what amazes me is the fact that if we look across history and the recent change in presidents, the expansion, the debt burden has increased dramatically, and the projections are for it to continue to increase through this Trump presidency.
No, absolutely. I mean, there's certainly a trend which is obvious looking at the graph, and there's no indication that that's going to change. So with the Fed rate going up, the debt going up, as I say, uncharted territory, and people really are sort of thinking, where shall they allocate their capital? I think perhaps many people haven't looked at gold before, but are now starting to look at it, and I think it's certainly worth reviewing.
Well, I think that's an interesting point as well, because traditionally, when looking back again in further history, when you looked at the peg to the dollar and gold, the central bank, the Federal Reserve, and of course the Bank of England here, had gold to sustain the currency allocation. That break has now gone, but I'm interested to see just how much the gold supplies have been dwindling in the developed nations, but but emerging markets are now buying up the gold. What's that tell us?
Well, I mean, there's definitely a trend there. I mean, there's another graph that shows this switch from the dark blue, which is gold in the developed market, moving to the rest of the world. Quite often we're talking about gold going from west to east. And I think the view is that when gold goes east, it's not coming back, and so it's almost removed from the system. And again, there is clearly a trend. How long that trend goes on for, we don't know. But I don't think it's unreasonable to speculate that it could continue for a while. And if the gold doesn't go back, then, or come back rather, then that lack of supply somewhere down the line could impact the price.
Which countries in the emerging markets are buying gold? Where is most gold being bought at the moment?
Well, Russia is buying a lot of gold. Turkey is buying a lot of gold. China is very active in the gold market. And as you can see, India. I mean, India historically has always been a huge buyer of gold. But just looking at the difference between Q4 2007 and Q4 2017, over 10 years, there's a huge leap in gold, or the appetite for gold from these countries.
Going back to the personal investor, why does it make sense for us to hold gold? You hear a lot about central banks in the case you've just been talking about here, but what about the personal possession of gold? Because gold will only go up by whatever, investment only goes up by whatever it goes up by. Whereas an investment in the market, you get dividends, you get further inflation gains, you get gains through earnings and so forth. Gold doesn't really make sense still, does it, as a personal investment?
Well, one thing about gold is it always traditionally provides purchasing power or enabling people to maintain their purchasing power. So it's really a safe haven asset. I mean, I don't think anyone's suggesting you put all your money in gold, but in times of uncertainty, if you want to protect your purchasing power, then I think people look to it. And especially at the moment, I mean, the gold price is around 1,200. The all-in costs of production of miners seems to vary between about 1,000 and 1,200. Obviously, some are more expensive, some are cheaper. But I think that the gold price is, if it's not at a floor, I don't think it's that far off a floor, because if it goes down too much, then people can't produce gold at a loss for a sustained period. They can do it. So
the supply dries out basically, or starts to dwindle.
Exactly. Over time, supply would start to dwindle, and people are talking about we've reached peak gold, and it's getting more and more expensive and difficult to find gold. I mean, it is a finite resource. You can't print it. It's not like money, and so I think it makes sense for people to perhaps just have a small investment in gold, for a rainy day.
Are you talking bullion here? Are you talking coins? Or do you expand out in your own portfolio to include those companies that are actually producing the gold as well?
I think it makes sense to have a bit of everything, to be honest. I mean, certainly bullion and coins, things like Britannias and things like that, you can get capital gains tax-free if you're a UK investor. And there's obviously some mining stocks. A lot of mining stocks are very close to their bottoms. Quite a lot of them have had 52-week lows relatively recently.
But that's mainly because, as you just said, is the fact that a lot of those, especially the small ones, are very close to the cost of production. That's the risk, isn't it?
It is. I mean, that's why I don't think you want to go jumping in with both feet into the market, because if the price did fall further, then some of these companies could be in trouble. But given that we are fairly close, or we could be fairly close to a bottom, it could be quite an attractive time to buy a few of these stocks.
Yeah, okay, look, Simon's pleasure. Thanks indeed for joining us. With the case once again to remind us of just what's going on in the gold market, not just bullion, but as Simon was saying as well, opportunities that do present themselves at the moment to shares. But do your due diligence if you go into shares of gold producers. As Simon was saying, there's a lot of things to consider when looking at that. That was Simon Popple from Brookville Capital.